Right now, something extraordinary is happening on Wall Street. Some of the world's most valuable technology companies are preparing to sell pieces of themselves to ordinary investors. The headlines make it sound like a once-in-a-generation opportunity. Artificial intelligence is reshaping industries. New billion-dollar companies seem to appear overnight, and for the first time, everyday investors are being invited to own a slice of what many believe could become the next generation of tech giants. It sounds exciting, maybe even historic. But before you rush through that open door, there's one question almost nobody is asking. Why is the door open in the first place? Think about it. In the stock market, every trade has two sides. For every buyer, there's a seller. If you're buying shares, someone else has already decided they'd rather have your cash than keep those shares themselves. That alone isn't suspicious. People sell stocks every day for perfectly reasonable reasons. But an initial public offering, an IPO, is different. The people selling aren't random investors checking their portfolios. They're usually the founders who built the company from scratch. The early employees who spent years helping it grow. The venture capital firms that backed it before anyone else believed in the idea. In other words, they're the people who know the business better than anyone on earth. They've seen the internal numbers. They understand the risks. They know where the company is succeeding and where it isn't. And after seeing everything the public doesn't get to see, they're choosing to sell. That doesn't automatically mean the company is bad. Far from it. Some IPOs become incredible long-term investments. But it does mean one thing. The people with the most information have decided that today is a good time to exchange part of their ownership for cash. So instead of asking whether a company is exciting, maybe the better question is this: why do the insiders believe this is the right moment to cash out? History suggests that question matters far more than most investors realize, because time after time, the biggest waves of public offerings haven't arrived at the beginning of a boom. They've often appeared much closer to the end. And if that's true, the AI race we're witnessing today might not just be a technological revolution, it could also be sending one of Wall Street's oldest warning signals. In the next chapter, we'll uncover a pattern that has appeared before nearly every major market bubble, and once you see it, you'll never look at IPOs the same way again. If you've ever played poker, you'll know experienced players rarely reveal what they're thinking, but every now and then, they give away tiny clues. A slight hesitation, a nervous glance, a subtle movement they don't even realize they're making. Poker players call these clues tells. Financial markets have tells too. The difference is they don't show up in earnings reports or television interviews. They appear in people's actions. Because what investors do with their money often tells you far more than what they say in public. There's a pattern that has repeated itself throughout modern market history. When confidence is soaring, when headlines are overwhelmingly positive, when everyone seems convinced that prices can only move higher, that's often when company insiders decide it's the perfect time to sell. Legendary investor Benjamin Graham once observed that intelligent investors sell to optimists and buy from pessimists. At first, that sounds backwards. Shouldn't you buy when everyone else is excited? Not necessarily. Think about selling a house. If buyers are lining up outside, bidding against each other, you're probably going to get the highest possible price. The stock market works in much the same way. When optimism reaches its peak, demand becomes incredibly strong, and that's exactly when insiders can often sell at the most attractive valuations. The numbers tell a remarkably consistent story. During strong bull markets, the number of companies choosing to go public tends to surge. When markets cool, those same IPOs often disappear almost overnight. That isn't because innovation suddenly stops. It's because market conditions have changed. Investors become more cautious. Valuations fall. Selling shares becomes far less attractive. So companies wait. This doesn't mean every IPO is overpriced. Nor does it mean every founder is trying to take advantage of public investors. Many businesses genuinely need capital to expand. Others want broader ownership or greater visibility. But timing matters, and history suggests that the busiest IPO periods often arrive when excitement is already running at full speed. By then, expectations are incredibly high, and high expectations can be dangerous, because once investors begin paying for perfection, even a great company can become a disappointing investment. That's the trap many people fail to recognize. They're not simply investing in a business. They're investing in the story surrounding that business, and stories have a habit of becoming louder just before reality catches up. If that sounds familiar, it should, because history has already shown us exactly what happens when optimism reaches those levels. More than once. And one example still stands as one of the clearest warnings Wall Street has ever produced. The year was 2007. Markets were booming. Confidence was sky high. And two of Wall Street's smartest investors made a decision that, in hindsight, turned out to be almost perfectly timed. History has a strange habit of whispering the same warning, long before most people are willing to listen. Let's rewind to 2007. The global economy looked unstoppable. Stock markets were climbing. Confidence was everywhere. Financial television celebrated record highs almost every week. To the average investor, it felt like prosperity had become the new normal, but behind the scenes, some of Wall Street's most experienced insiders were making a very different decision. One of the world's largest investment firms chose that exact moment to sell part of its business to the public. The timing couldn't have looked better. Demand was strong. Investors were eager. The excitement surrounding financial markets was difficult to ignore. Then, barely a year later, everything changed. The global financial crisis erupted. Banks collapsed. Credit markets froze. Stock prices tumbled across the world. Companies that had looked unstoppable suddenly lost enormous portions of their value. Looking back, it's hard not to notice the timing. The people closest to the business reduced part of their ownership, while public enthusiasm was at its highest. Whether that timing was perfect planning or simply remarkable foresight, history leaves us with an uncomfortable question. What did the insiders see that the broader market didn't? And 2007 wasn't the first time this pattern appeared. Nearly a decade earlier, another wave of optimism swept through Wall Street. The internet was transforming the world. Every new technology company promised to change the future. Investors weren't just buying businesses anymore, they were buying possibilities. Hundreds of technology companies rushed to list their shares on public markets. Many had ambitious ideas. Some had very little profit, others barely had a proven business model, but that didn't seem to matter. The excitement became so intense that valuations drifted further and further away from reality. Eventually, reality caught up. When the dot-com bubble burst, trillions of dollars disappeared from global markets. Many companies that had once been celebrated simply vanished. Some were acquired, others failed completely. Only a small number survived to become the technology giants we recognize today. The lesson wasn't that technology was a bad investment. Far from it. The internet changed the world forever. The mistake was assuming that every exciting company automatically justified any price. Innovation creates opportunity. Speculation creates bubbles. And confusing the two has been one of the most expensive mistakes investors have made throughout history. Which raises an important question. If history keeps repeating the same pattern, why do investors keep falling for it? Because every generation believes this time is different. And that's exactly the mindset that created one of the most extraordinary investment frenzies of the last decade. Every major market bubble has one thing in common. It doesn't arrive wearing the same disguise. The names change, the technology changes, the headlines change, but the psychology stays remarkably consistent. After the dot-com bubble faded into history, Wall Street eventually found a new way to package excitement. This time, it wasn't traditional IPOs grabbing all the attention. It was a financial shortcut. Companies could reach the stock market faster, with fewer hurdles and far less scrutiny than a conventional public offering. Investors loved the idea. The media called it innovation. Money poured in. Within a remarkably short period, hundreds of these deals flooded the market. Many promised revolutionary businesses. Others painted ambitious pictures of the future long before their products had proven themselves. For a while, it looked unstoppable. Valuations climbed. Speculation accelerated. Optimism spread faster than careful analysis. But eventually, reality arrived. As market conditions became more difficult, many of those once celebrated companies suffered dramatic declines. Some lost the majority of their market value. Others disappeared from investors' radar almost as quickly as they had appeared. Once again, the pattern repeated itself. When confidence was overflowing, companies rushed toward public markets. When confidence disappeared, so did the rush. The financial vehicle had changed. Human behavior hadn't. And that's the lesson history keeps teaching. Markets rarely create brand new mistakes. They simply give old mistakes new names. Which brings us to today. Artificial intelligence has become the biggest technological story of the decade. Every week seems to bring another breakthrough, another billion-dollar valuation, another announcement promising to reshape entire industries. The excitement feels almost impossible to ignore. Governments are paying attention. Investors are paying attention. Businesses around the world are racing to adopt AI before they fear they'll be left behind. And once again, the biggest technology companies are investing at a pace we've never witnessed before. The question isn't whether artificial intelligence will change the world. It almost certainly will. The real question is something far more important. Are investors buying a technological revolution, or are they paying almost any price simply because they don't want to miss it? Because history suggests those are two very different things. And the numbers behind today's AI boom reveal a story that most headlines barely mention. The world's largest technology companies are spending hundreds of billions of dollars on artificial intelligence. But when you compare that spending with what the industry is actually earning, the gap is almost impossible to believe. Every technological revolution begins with extraordinary promises. Railroads, electricity, the internet. Each one transformed the world in ways few people could have imagined. Artificial intelligence may very well belong on that list. Its potential is enormous. It can automate tasks, accelerate research, improve healthcare, reshape education, and change how businesses operate. None of that is in question. The real question is something else entirely. How much should investors be willing to pay today for profits that may not arrive for years? Because building the future isn't cheap. The world's largest technology companies are investing staggering amounts of money into AI infrastructure, new data centers, specialized chips, cloud computing, advanced software. The race has become one of the most expensive technology build-outs in modern history. The scale is almost difficult to comprehend. Every single day, billions of dollars are being committed to expanding AI capabilities. The expectation is simple. Spend heavily today. Earn even more tomorrow. But that's where the story becomes far more complicated. For all the excitement surrounding artificial intelligence, the financial returns haven't always kept pace with the investment. Many companies are still searching for sustainable business models. Some AI products are attracting millions of users while generating far less profit than investors expected. Others continue spending aggressively in the hope that future demand will eventually justify today's enormous costs. That's not unusual for a young technology. Innovation often requires years of investment before meaningful profits appear. But financial markets don't simply value what a company earns today. They also value what investors believe it could earn tomorrow, and expectations can become incredibly powerful. When optimism is high, future success often gets priced into today's stock price long before it actually arrives. That's why valuation matters. A remarkable company can still become a disappointing investment if investors pay far more than the business is realistically worth. History has shown that lesson repeatedly, not because innovation failed, but because expectations became detached from reality. That's why experienced investors spend just as much time analyzing valuations as they do analyzing technology. They understand that great businesses and great investments aren't always the same thing. Sometimes they're separated by only one number. the price. And right now, that may be the most important number in the entire AI story. Because one company sits at the very center of this revolution. Its products are changing the world. Its influence continues to grow. Yet its financial picture tells a story that many investors have barely begun to examine. The company leading the AI revolution has become one of the most valuable private businesses in history. But when you look beneath the headlines, the numbers raise a question almost nobody is asking. Every investment boom tells the same story. At first, there's a breakthrough, a new technology, a new industry, a new promise that this time, everything will be different. Then comes the excitement. Prices rise, success stories dominate the headlines. More investors rush in, afraid they'll miss the next big opportunity, and eventually, the line between investing and speculation begins to disappear. That doesn't mean artificial intelligence is a bad investment. Far from it. AI could become one of the most important technological revolutions in modern history. The mistake isn't believing in the technology. The mistake is believing that every company connected to the technology is automatically worth any price. History has never rewarded that kind of thinking. From the railway boom, to the dot-com bubble, to the housing crisis, markets have repeatedly shown that revolutionary ideas and profitable investments aren't always the same thing. Great businesses can still become poor investments when expectations outrun reality. That's why experienced investors ask different questions. Instead of asking, how high can this stock go, they ask, what assumptions are already built into today's price? Instead of chasing excitement, they study incentives. Who is buying? Who is selling? Who benefits from today's optimism? Because every transaction has two sides. Every share purchased has a seller. And sometimes, the most valuable information isn't hidden inside a company's financial statements. It's revealed by the behavior of the people closest to the business, the people choosing to sell. That doesn't mean insiders are always wrong, nor does it mean every IPO should be avoided. Some will become extraordinary companies. Others won't. The challenge is knowing the difference before history makes the answer obvious. Artificial intelligence will almost certainly reshape the future. The real uncertainty isn't whether AI will change the world. It's which businesses will still be standing once today's excitement gives way to tomorrow's reality. Markets have always rewarded patience. They've rewarded discipline. And they've rewarded investors who can separate a remarkable business from an overpriced stock. Because in investing, the biggest risk usually isn't missing the next opportunity. It's paying tomorrow's price. Today. And perhaps that's the lesson history keeps trying to teach us. Technology changes, markets evolve, but human psychology rarely does. The smartest investors don't simply follow the crowd. They ask the question most people never think to ask. Why is someone so eager to sell me this opportunity? If you enjoyed this documentary, explore one of the videos on your screen and continue learning about the financial systems, market psychology, and investment principles that shape our world. Subscribe to ZK Finance for more cinematic financial documentaries that make complex topics simple, engaging, and easy to understand. Until next time, stay curious and keep learning.